Most people think money is loud. They picture big wins, viral startups, stock tips, lottery stories, crypto explosions, overnight success. The headlines reinforce it, social media amplifies it. We're trained to believe wealth arrives in bursts. But real wealth, the kind that lasts and compounds, follows a different pattern. It is quiet, and because it's quiet, most people never notice it, even when it's happening right in front of them. This is the quiet money pattern. It does not look exciting, it rarely makes the news. It almost never feels dramatic, but it works with stubborn consistency. Let's break down what it is, how it works, and why so many people miss it. 1. Quiet money moves slowly at first. The quiet money pattern starts small, almost boringly small. A person saves a few $100s a month, someone invests in a broad index fund. A freelancer raises rates by 10%. A business owner reinvests profits instead of upgrading their lifestyle. Nothing about this feels life-changing. In year 1, the numbers barely move. In year 2, still modest. In year 3, it looks respectable but not impressive. This is the part where most people quit. We are wired for visible progress. We want the scale to drop quickly. We want income to double fast. We want results that can be screenshot and shared. Quiet money does not provide that early emotional payoff. Instead, it relies on time, and time is invisible while it's working. Compounding is the engine here. A dollar invested earns returns. Those returns earn returns, then those returns earn returns. But compounding looks flat in the beginning. The curve is shallow. The growth seems underwhelming. Then, years later, it bends upward. By the time others notice, the foundation was built long ago. 2. Quiet money is built on boring systems. If you look closely at financially stable people, you rarely find chaotic strategies. You find systems. Automatic transfers to savings, automatic investments. Regular reviews of expenses, incremental skill upgrades. Long-term planning. There's no adrenaline in this, no drama, no secret knowledge, just consistency. A simple example. 2 friends graduate at 22. One tries to pick hot stocks, jumps in and out of markets, follows trends. The other sets up an automatic monthly investment into a diversified fund and leaves it alone. 10 years later, the second friend often wins, not because they were smarter, because they were steadier. The quiet money pattern favors people who reduce friction. They make the good choice automatic. They remove the need for constant willpower. Most people underestimate how powerful this is. They think success requires constant brilliance. In reality, it often requires removing the need to be brilliant every day. 3. Quiet money avoids lifestyle inflation. Here's one of the most invisible parts of the pattern. Income goes up. Lifestyle does not rise at the same speed. When someone gets a raise, many immediately upgrade their apartment, car, subscriptions, travel habits, and daily spending. Their bank balance changes, but their margin does not. Quiet money works differently. When income increases, savings rate increases first. If someone goes from earning $60,000 to $75,000, they might continue living as if they earned $60,000 for a while. The extra $15,000 becomes investment capital. That gap between income and expenses is where quiet wealth grows. It's not flashy. No one applauds you for keeping the same car. No one congratulates you for ignoring a luxury upgrade. But that restraint compounds. Over time, it becomes options. Options are the real form of wealth. The option to leave a bad job, the option to take a sabbatical, the option to invest in a business idea, the option to help family. Most people chase visible upgrades. Quiet money chases invisible flexibility. 4. Quiet money prioritizes skill over hype. Another reason most people miss the pattern is that they focus on assets before income. They want to find the perfect investment, but the highest return investment for most people early on is skill. Learning to negotiate, improving communication, developing technical expertise, building a reputation for reliability. These things are not glamorous, they do not trend on social feeds, yet they increase earning power. And earning power is the fuel that drives investing. A person who increases their income from $50,000 to $100,000 through skill development has dramatically changed their wealth trajectory. If they then apply the quiet money pattern to that higher income, the results multiply. People often try to shortcut this. They look for the next big opportunity instead of strengthening the engine that generates income. Quiet money focuses on the engine first. 5. Quiet money survives downturns. When markets drop or industries shift, loud strategies suffer. The trader who bet big on a single stock feels it immediately. The business built on a trend collapses when attention moves on. Quiet money is diversified. It spreads risk. It avoids concentration in a single idea. It keeps emergency savings. This doesn't eliminate risk, nothing does. But it prevents a single mistake from destroying years of progress, and survival matters more than brilliance. The person who stays in the game for 30 years usually beats the person who tries to win big in 5. The quiet money pattern understands this deeply. It is not trying to look impressive this quarter. It is trying to remain standing decades from now. 6. Quiet money is emotionally boring. This might be the hardest part. Quiet money does not provide daily excitement. There are no big spikes of dopamine. You check your investments and see slow growth. You make your monthly contribution again. You decline a purchase others are making. You choose patience over impulse. It feels repetitive. But that repetition is the point. Most financial mistakes are emotional: panic selling, impulsive buying, overconfidence after a win, despair after a loss. The quiet money pattern reduces emotional swings. It creates rules in advance. Invest regularly, rebalance occasionally, avoid high-interest debt, keep expenses below income. Simple rules, followed consistently. Over time, this emotional stability becomes a competitive advantage. 7. Quiet money is often invisible to outsiders. Here's why many never see it. The person building quiet wealth does not necessarily look wealthy. They may live in a modest home, they may drive a reliable but older car, they may avoid status purchases. Meanwhile, someone else may appear successful: designer clothes, frequent luxury travel, high-end electronics. But appearance is not balance sheet. The quiet money pattern often hides behind normalcy. You do not see the automatic investments. You do not see the growing brokerage account. You do not see the absence of debt. You see what is displayed, and what is displayed is often finance. This creates a distorted perception of wealth. People assume that the most visible consumption equals the most financial success. In reality, the opposite is frequently true. 8. Quiet money compounds in multiple layers. Compounding is not just financial, it happens across several dimensions at once. Money compounds, skills compound, reputation compounds, relationships compound. A person who consistently delivers good work builds trust. That trust leads to better opportunities increase income. Higher income fuels investments, investments generate returns, returns create freedom to pursue higher level work. Each layer reinforces the others, but because this happens gradually, it is hard to notice in real time. You only see the outcome years later and think it was sudden. It rarely is. 9. Quiet money requires identity shift. Many people struggle with this pattern not because it is complex, but because it requires a different identity. You must see yourself as someone who lives below your means, values long-term stability over short-term status, makes decisions your future self will thank you for. That identity can feel isolating in cultures that reward visible spending. It takes confidence to drive the practical car when others are leasing luxury models. It takes patience to invest steadily while others chase trends. The quiet money pattern asks you to detach your self-worth from display. That is not easy, but it is powerful. 10. Why most people never see it. Now we can answer the core question: why do most people miss this pattern? Because it does not create stories. There is no dramatic turning point, no viral breakthrough, no overnight transformation. It is a series of small, disciplined decisions repeated for years. Humans are drawn to narratives with clear peaks and valleys. We love the comeback story. The risky bet that paid off, the genius who saw what no one else saw. The quiet saver who invested consistently for 25 years is not a thrilling headline. But they are often the one who achieves durable wealth. Another reason is impatience. We underestimate how long meaningful results take. 10 years sounds long, 20 years feels abstract. But wealth, like health, responds to long timelines. Small habits, sustained, beat short bursts of intensity. Finally, many people are distracted. They are reacting to daily news, market swings, social comparison, and short-term pressures. Quiet money requires focus, not constant monitoring, but steady direction. If this video got you thinking about money in a different way, that's the goal. The quiet money pattern isn't flashy. It's not built for headlines, but it works. And if you stick around here, we're going to keep breaking down ideas like this in a way that's practical, honest, and actually useful in real life. If you found value in this, take a second to like the video. It helps more than you think. It tells YouTube this kind of content matters. Make sure you subscribe. If you're serious about building smarter habits around money, work, and long-term growth. We're not chasing hype here. We're building something that lasts. And don't forget to turn on notifications, so you don't miss the next video. Consistency is how wealth grows. It's also how this channel grows. Drop a comment and let me know. What's one quiet financial habit you're working on right now? I'll see you in the next one.